So Peter Lynch's #1 rule for avoiding bad stocks is to check the debt first. He said if you can do math, then you can spot a potentially dangerous investment. Now, I was just in Chicago with Ian Lopik at the Blossom Investor event, and crazily enough, I was on a panel with him, and as I was sitting there watching him talk, he brought up balance sheets and how important they are when you're looking at a stock. And this Peter Lynch clip from Louis Rukeyser's Wall Street popped into my head from 2002.
What are the most conspicuous mistakes you've seen investors make?
Well, I think not looking at the balance sheet, and this is a mistake I've made. If you look at, if you look at a person's balance sheet, you look to see what the assets they own, their houses, if they own a house, if they own a car, what debt they have, and take that away, that's what your net worth is. You should do that with a company. And I've seen investors look at companies that let's say looking at two companies, they're very depressed. They're each at $4 a share, and they're each losing a couple $1 million a quarter. One company has $100 million in cash and no debt, and one company has no cash and $100 million in debt. They're about to blow taps on the second company. So you could do this. If you get through 8th grade math and you get anywhere near 8 and 8 equals 16, you can do this. Look at a company's financial position. It's impossible to go bankrupt if you don't have any debt. I mean, you get the Irving G. Thalberg Lifetime Achievement Award. I think they're bad management. I mean, how could you do that?
If you're a new investor and you haven't, do yourself a favor and just type in Peter Lynch and watch some interviews with the guy. Highly entertaining, highly educational, and somebody that both Ian Lopik and myself are very fond of. But let's break down what he said. So a balance sheet shows what a company owns and what it owes. Say you had $300,000 of assets, but you also had $200,000 of liabilities, then your net worth would be $100,000, and companies work the exact same way. So in Peter's example, he mentioned two companies. Both are losing money. Both stocks are at $4. Company A has $100 million in cash and zero debt, while Company B has zero cash, but $100 million in debt. Company A can lose money for about 50 years, while Company B is already in big trouble. It's like the difference between someone living paycheck to paycheck and someone with savings. If they both lost their jobs, who do you think would have the easier time surviving? So when you buy a company, you're not just buying their earnings today, but you're also buying their ability to survive really tough times that are probably going to happen in the future. So check out this example with two actual real companies. Now this comes to us from alphaspread.com, which I like the way they present it, and it'll be real easy to show you, but we're looking at Microsoft, and you can sign up with an email address and get 3 company looks a week. But we're looking at Microsoft and their balance sheet, where you can see that they have cash and short-term investments, which are highly liquid, of $94.6 billion. And when we look at Microsoft's liabilities side of the balance sheet, we see that they have $83.2 billion of long-term debt. So Microsoft has more cash than debt, and they could write a check tomorrow and be debt-free and have over $11 billion of cash left. And if we look at simplysafedividends.com, we can see why their net debt to capital is basically zero. And they have an ICR, which is interest coverage ratio, of 53.0, which means that Microsoft has $53 of earnings before interest and taxes, or EBIT, to easily cover every $1 of interest on their debt. Microsoft has a hella safe balance sheet. But now we'll look at a company that I ended up selling out of because one of the things that made me a little uncomfortable was their balance sheet and their debt issue, and that is Nexstar Media Group, ticker NXST, where they have cash and short-term investments of $234 million, but they have long-term debt of $6.3 billion, which means they have less than 4% of the cash they would need to pay off their debt. And looking again at simplysafedividends.com, their net debt to capital is 0.75, which means that 75% of their capital structure is borrowed money, and their interest coverage ratio is 3.01, which means they have $3.01 of earnings before interest and taxes, or EBIT, to cover every $1 of interest on their debt, which is not a lot of wiggle room if their EBIT starts to fall. So if Nexstar's business drops, they are stuck making those payments with very little cushion. So I hope that was a really easy visual that you could see the difference. And you also have to know that if you are a dividend investor, high debt could potentially be toxic to your dividends, because when business slows down and money gets tight, who do you think's going to get paid first, the bank or you? The bank. Always. It's the law. Your dividend will get cut. And I think we saw this during COVID because a lot of low debt companies just kept right on making those payments, but high debt companies slashed those dividends to be able to continue making their interest payments on the debt. So if you want reliable dividend income, it would be prudent to look for those companies with low debt and flexibility to keep on paying you through the tough times. As Peter Lynch said, it's impossible to go bankrupt if you don't have any debt. And he's right, because without debt, nobody can force you into bankruptcy. But if you have lots of debt and no cash, a bad year or two and your stock can go to near zero. And if you want a quick and dirty way for free to check a company's debt situation, you can go to the former finchat.io, which is now fiscal.io. And with the freemium version, you can check it out. So here we go, Microsoft. What you want to do is click on financials. You can access the last almost 10 years of income statement, balance sheet, cash flow statement. There's a lot of information on fiscal.io, but click on ratios, and we want to collapse the trailing valuation and go down to financial health, where you can see that the current net debt for Microsoft is negative $34 billion. But if we do the same thing for Nexstar Media Group, you'll see that their net debt for the last 12 months is about $6.2 billion. But a great rule of thumb for reliable and largely safe balance sheets is to look for companies that have more cash than long-term debt, a net debt to capital of about under 0.4, and I like an interest coverage ratio of at least 5 to give a company wiggle room to make sure they have enough EBIT to pay every $1 of interest on the debt if times get tough. And you can easily find that all out in a couple minutes. It's a simple question to ask, right? Before you buy any stock, ask yourself, if they have a really rough year or two, are they going to be able to survive? Because if they're buried in debt, they might not. So always make sure to check that balance sheet. The sooner the better. And if you do want to see what this welder is buying and investing on, click the link below. Follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. And again, thanks to Max and Brandon at the Blossom team. It was so fantastic to see so many other creators and investors, and I know they're going to do it again. And if they do and you get the chance, you definitely want to hit up one of those. And now, in this floating little box next to my head, I had a fantastic conversation with Kelly Green, who writes the Dividend Digest for Malden Economics, and she shared a few of the sectors that she likes. So if you want to find out which those are there, then click that floating little box next to my head and we'll tell you all about them there.